Welcome. It's the Market Sniper. Been a while talking to you. Yes, glad to be back. Bit of housekeeping. If you're in the Florida area, come and check us out. Link below. We'll be at the Boca Raton Rick Rules Symposium. If you're looking for a ticket and want to come and say hi, we'll be there, and it's the better part of a number of days. In fact, I think it runs from the 7th to the 11th, so we'll be there for the entire event in Boca Raton, Florida. So those of you that are in Florida or maybe going to Florida during that period, check us out and come and say hi. As an attendee, we'll be roaming around and listening to all the best speakers. Other than that, what am I talking to you about today? Wow. There's a lot of easy confusion going on, and people are jumping all over the USD JPY and laying claim to it, and new people to the USD JPY or the yen weakness. It's actually not all about dollar strength. There is a reasonable element of dollar strength. It is a yen weakness trade, as we've highlighted before with the Euro JPY, the CAD JPY, the Aussie JPY. We've got the Rand gaining ground and having positive carry on a great level in setups against the JPY. The common thread actually is the trapped yen status, and we've said a number of times the trade that people have not got as a long-term holding. We mentioned quite a long time ago when Druckenmiller going into 23, when it was 22 and going into year 23, when asked what the core theme was, is how is he not talking about the weakness of the yen and also the potential of the Nikkei, and that was better part of 2 years ago, and that is the key trade. It is one of the few FX trades that I say you can portfolio as a long-termer, and it will be the gift that will keep giving, even though it will have pullbacks. There are no straight moves. People that are late to the space have jumped in and said, we're going to 250, we're going to 2. It's typical of people that are late to the trend. They just come in more aggressive to almost steal the space from people that are taking it pattern for pattern at a time. I mean, we've spoken of 165 pullback and then further upside because we have setups. But this is a trade that's going to keep on giving. And the other element is, I have to say this because I'm seeing George and I'm seeing Brent, and it's all dollar milkshake. It's not dollar milkshake if it's about the yen weakness more than it is about dollar strength. The dollar has actually lost ground to the Mexican peso for 3 years in a row. It's lost ground to the Singapore dollar over the last decade and a half. It's lost ground to the Swiss franc over the last 2.5 decades. It is reasonably strong, it has to be said, and of course it's the major currency of the world, so it is firm, and it's not a nothing part of the story, but it is actually debt collapse that is behind all of this, and the fact that the Fed needs to be out front as the biggest purveyor of debt with interest rate hikes, which is actually debt devaluation. So the dollar bulls that are so proud of being the least dirty shirt in the laundry are actually not talking about the absolute failure in debt valuations on the American side that is the leading outcome of ever escalating rates. We're going to go and have a look at the debt markets after we've reminded you of the USD, JPY, and many of the other crosses that we've had, that we've discussed in our community. And the other benefits, by the way, of not just having a USD, JPY long, and we've spoken to this about many people as a risk off beautiful hedge. So if you're long stocks, etc., and you want to make some money and reduce your downside if the share market sells off or the tech stocks sell off, whatever the case may be, etc., you have a USD JPY on, because the USD JPY, when risk goes off, a lot of money flows back into the dollar. But the handy thing is having yen longs for when the dollar actually has a spell of weakness. You have, for example, the Euro JPY, and it continues to make great ground as well. And that's not a punt for how awesome a currency the Euro is. It's a fact that you actually look after both sides of dollar strength and then euro strength, because they tend to have a little bit of a seesaw relationship. It's the biggest pair and you get flows. When your USD JPY is pulling back a little bit because the dollar's coming off a little bit, bad data or something, your euro JPY will lean forward a bit for you. So you can build and portfolio and long-term hold these trades, which we have put up and made key and central to our trading. And in fact, I have to tell you, in our business, people have said, you keep talking about the yen and the Nikkei. This was 3 years ago, 4 years ago, right up until about a year and a half ago. Why do you do yen videos? They get the worst watch, the worst likes, the worst stat numbers, the worst everything. I say, because it's the right financial trade to be talking about. We are here to educate people. If people were asked what would they want more of, they would have told Ford that they wanted a faster horse. I brought the trade before the trade to people that now everybody else is jumping in on, and that is, hey, you should be short yen. You should be short yen against the dollar, you should be short yen against the euro, and in select cases you should be long export Japanese equities. And as I say, go and have a look at our YouTubes. We're the first to talk about that. And it was a big technical setup using HVF method. On HVF method, by the way, let me just jump in and change tax for a while before we refer to those charts. On HVF method, there are no trading metamorphosis programs anymore available. Do not book a call for a trading metamorphosis program. We do not have one available for you. Okay, it's been completely suspended. We've got a good chunk of community. We'll see if that, if and when that particular offering will come back. However, you can book a call to have a look at our self-study, which will take you to a beautiful platform that has all the videos that you get in the TMP to watch. Plus, you will get the Sunday session with our Sunday presenter, and you will get me included every month on the live trading day, which, by the way, is coming this Friday. First Friday of the month. Remember, data often follows in trends. 2 months ago, we had a change in trend. Are we continuing to see signs of weakness for the employment numbers, which, as Powell recently said, tend to overstate a little bit? Overstate. Lying stats. Fancy that. Lies, damn lies, and statistics with the birth-death model. Who would have thought it? But anyway, so you will get all those elements together. So you're actually getting some interaction on the Sunday. You will not be in the community every day and getting the daily updates that goes with the trading metamorphosis program, but you'll get all the theory. And in fact, what we do is you will have 6 months on that program, and 3 months in, if the trading metamorphosis program comes back, we'll give you an opportunity to upgrade, which will take into account that which you've already provided. And it's a third of the cost. So you can get the real rub on the theory, get a weekly with a recording, interaction with the trade leaders, as well as monthly with myself on both the crypto markets. Anyway, for that, book the link below. Let's have a look at the charts. Let's have a look at the USD JPY, which is getting all the milkshake boys so excited. It's a debt collapse. But let's go straight to the milkshake trade. Here we go. That is the USD JPY. And of course, we began talking about this as this was setting up. And we were saying, what's going to happen? What's going to happen? Is this going to be upside continuation? Can I also say I was on a Forex desk trading that HVF up long and that W bottom that didn't go as low. It's kind of an inverted head and shoulder, actually, like that. I remember this, and this was the bottoms. Don't forget, that was 75. We're talking about 161 at the moment, and we've got 165 targets. You can see our alerts now. You can see how things change. What a spit up that was. That was the quantitative easing. And of course, that followed also, it has to say, that was the Kobe earthquake. That was the dip to the downside. We had an inverted HVF in there. We traded it. We actually bought yen before a natural disaster. How did the markets know, I wonder? There's a big deep dive you need to do on the events surrounding Fukushima. But that's for another channel, another discussion, another day. Don't want to take you into too many white rabbit holes in one moment. That was a spiller, an absolute thriller. Then it came down. They said no more of that. Guess what happened? Long shot ex-Prime Minister Abe got in unexpectedly and brought his new finance minister with the 3 arrows policy. I think that's 3 fingers. Let me double check. The 3 arrows policy in he came, and that was, of course, quantitative easing. Quantitative easing must destroy the yen, must destroy the yen, must destroy the yen. That is how we'll deal and maintain our Ponzi scheme, given that we had so much debt. We traded that to the long side. It then had this very lengthy, I will remember that was like watching paint dry for the continuation there. Then it surged. This was a head and shoulder that we traded to the short side again. A little squeezy that went up, and then you could see that was getting bearish, bearish, bearish all the way down. I literally felt every aspect and was an FX trader predominantly here. This is pre-Bitcoin, only started getting into and discussing Bitcoin in this period. So all of this was, pre-Bitcoin for me. And then we had this huge, and we were talking, I was telling everyone who would listen in our community that there's a big macro upside or downside move. We didn't know immediately at first. Then we got the bid up, we got this squeezy, you squeezed here. That was the beginning of a major leg up. You could have got in and around the levels of 109. Next thing you knew, you were through 150. That served as an ascending structure for quite some time. You got resisted there and you got resisted there again. That brings us to where we are today. And everyone else now charging into the USD JPY trend. And it's the reason why rates are going up in American debt. I'm afraid, guys, if Japan is selling their American debt to shore up their own debt markets, that should make the yen strengthen and the dollar weaken. Because the debt is being given to someone else, the dollars are being attained, and they would be repatriating the money into yen. That means they would be selling dollars and buying yen and repatriating their money. If Japanese central banks, Bank of Japan, or major institutions were in fact doing major selling of Fed holdings, treasuries, that would put downward pressure on the dollar and upward pressure on the yen. And what we're actually seeing is the yen continuing to grind up. In fact, if you listen to the interview, and I've referred to this often, go back and watch the Prof. Werner chat that we did. The Bank of Japan and the Japanese economic Bank of Japan institutions that are around that determined policy are largely owned and controlled by the Fed. They cannot get too independent, otherwise they'll be stamped on and they will find themselves in repercussions, or they might have a regime change. That's right. They might find themselves losing their jobs. So that's kind of how it is. There was a peace agreement, at least signed post-World War II, which Germany never actually got. So policy for Japan can't get too independent. And they have been one of the holder-uppers of the USD Treasury market, along with the UK. Belgium, mighty Belgium, the big buyer. And in fact, the people that have been disposing, the half of the planet that's not going to get as destroyed as the West, has actually been China, who has been selling treasuries and has been purchasing gold, which is a far better thing to do, of course. So just a bit of a point out and a shout out to those that are insinuating that it's the Japanese that are selling T-bills and that's why their currency are weakening. No, I'm sorry, that logic doesn't get squared. They would strengthen their currency, at least on a short-term basis, unless they were already getting absolutely killed. And it just slowed down the downside. So we've had lots of setups that pertain to the USD JPY, and I will be reminding you also of the Euro JPY and all the other crosses, just to make it clear that, again, this is not about the dollar, purely about the dollar. This is about different things entirely. It includes the other currencies that are also winning against the yen. So let's just see. Will you give me what I want? Will you give me what I want? Quick. No. That's the one I was wanting. So that was the first run. Then you had a bit of overperformance down. We got a double bottom that performed, brought you back up to that level down. Now you've been squeezing higher. These were, I've already mentioned. I'm not going to go back and draw those. They were done on a lot longer. And as we have shown here, I just want to double test that. That is the high that was made there was 151.944. And that was 151.908. So we can highlight some other highly ascending structures. Now here's the interesting thing that occurs with ascending structures. It's super interesting, this. So we're going to put another draw using our HVF draw tool, which has been made available for all year-long members of our Trading Metamorphosis program. That's implying a 177. So you won't hear a bigger number out of me yet than 177. There's of course a smaller time frame pattern, so that's overlaid that ascending structure there, 177. You are actually at a second interim now. So if you jump off right away and you go and smash the bid for USD JPYs, you're quite likely going to run straight into the fact that you are going to get a pullback potentially. But the long run only higher, but you could get a technical pullback here. It's the first time we've crossed that second interim on the USD JPY. I'm going to be going on to explain that this is actually a debt-based thing. All of these people, this global economic system is a debt collapse. It's not just about the USD JPY. Let's finish showing you all the setups on the USD JPY, and then we're going to show you the other currencies so that you can see that other currencies are going up against the yen too. And then we're going to show you the real driver that has many people confused, many people with big YouTube channel accounts that are getting kind of excited. Let's go 12 hours and pick up this guy. Oh, it's worked. It's done the draw. So the short term, you're getting HVFs all the way. That's our 165. Don't forget the 177 of that bigger draw that I gave you. Let's just, now that we've changed time frames, let's just grab that low a little better so it can redraw the 177 for you. So you should see that there. You can see the 177. So you'll probably have a rest there. You are at the second interim of the bigger setup, and you've just made your own second interim. So there's a cluster of levels here. So you could have a pullback during this period. Then you will have open territory to run to the target here. And you can see the alerts we've put. We'll also put some as 177 runs so that people can remember that there are big HVF targets run. So there are going to be periods and shock and awe systems and games that they will play to shake out the traders that are getting the one-way trade. Do not be entering at the latest moment at key levels of significance like targets or second interims. You want to buy on the pullbacks after they've pulled back for a while. These were great entries over here. These were great entries. Let's circle them for you. In the smaller time frames, that hammer was great. Hammers are your friend. Once you started moving, doesn't matter if you got up there, you're still getting cheaper than there. Very low vol periods. Sitting on the funnel of the macro after triggering. Wait and get the takeout of the tops. Boom, you get in long there of that ledge. Boom, boom, bosh. You would have been washed and seen all your profits washed out. You probably would have needed a stop there. And you would have gone backwards a little bit. You might have got roughly back to your entry. I've kind of pulled it a bit down. But roughly watched some profit wash out in actual fact. That's why after a major pushback like that, and that is actually the best time. The fundamentals of this trade is they cannot really raise their interest rates. And what is happening? What is happening is rates are rising on US debt. Why is that happening, dear Brent Johnson? Because nobody wants to buy the debt. And that's what's pushing rates up. The greater issuance, of course, there was the daily note was saying massive deficit in the US. You're not selling enough American goods offshore, and you're buying loads of stuff from people. You're buying too many Mercedes, BMWs, Kias, and Huawei's, and you're not selling enough Fords, Apple phones to those same nation countries. When you run a deficit, what tends to happen? It puts pressure on your balance of payments, and those people stop buying your debt. The original petrodollar, and lots of people say, why haven't you commented so much on the petrodollar, you know, the ending of the petrodollar and all of that? Because there wasn't really a specific written down agreement that we've been allowed to see that I can say, that's an agreement. But generally, the Saudis have always adhered to cycling money into the treasuries. Now the debt market has turned. How keen do you think the Saudis, that will eventually run out of oil, want to take their gift of oil money and turn it into treasuries that, don't forget, the 30-year lost 45% of its capital value? The dollar bulls aren't telling you much about the fact. The people that brag on Twitter of their dollar bulldom are not telling you about how much more American debt has lost. Now, that's not to say I'm suggesting buying other nations' debt. Don't buy anybody's debt. It's a debt collapse. But some are allowing one pressure valve to let some of the pressure out, and others are allowing another, and some are doing a mix of both. And what needs to happen actually is debt valuations have to go way, way down, and rates spike is the real story of this particular crisis. So I will quickly show you my next point just to make it very clearly. We actually got very clean structures on the euro JPY. So if the dollar's so strong, why is the euro JPY going up too? There's weekly, there it is, there's a setup. Let's grab him. In fact, there's a bigger setup, and we've spoken about this guy a lot. Let's get him, let's put him on here, bring him around, and we need to mark bridging the trend. Let's have a look at that, and you will see now, and when that updates, as to why we say it's not just a dollar story. This is the euro JPY. That is a place where you'll get a 227 number out of me, a 200 number, because this is a geometric pattern. And by the way, I don't believe it stops there, but it might have a sustained period of rest. By the way, again, I'm going to take these other patterns off. I took the wrong one off there. Let's put that one back in a second. Let's do it one more time. We had 3 drawn on there. Let's put it back. So you are, as everybody is busy talking about it right now, invariably likely to have a bit of a pullback. That is why we are where we are. Everyone is talking about it. We want to come out and warn everybody. You've just run the second interim on a macro. This should be a monthly. I could put it on a 2-weekly, a fortnightly. Let's try the 2-weekly because the candles are just so compressed. And we could put it on a monthly. You've just popped in a highly momentum way with a gap. We'll show you that on a lower time frame on the euro JPY through the second interim. That is going to 227. Can you see what I'm saying? This is more about yen weakness because their rates are off than it is just about the dollar trade. This is a much bigger pattern with a huge target. By the way, we've also spoken about the CAD JPY. Is there anyone talking about a Canadian milkshake that you know of, apart from old Castro Kid and his histrionics? Does anybody have a Canadian milkshake in the mix? No, nobody is talking about it. So yes, the dollar's been pretty firm, but it's far from the strongest currency out there. So if we put that on there, you will see this is a massive pattern. I need a chart that's going to give us a little bit more history. FXCM, you are garbage. Where's your history? Where's your history? Where's your history? Saxo's pretty good on history. Let's see. There we go. A bit longer on the history. Are they? Let's see. Here we come. We're coming around the mountain, guys. Yeah, so this is the move against the CAD. This is it. Yeah, there's pullbacks along the way, but look at those candles. That is a proper runner. It is jogging on without too much of a doubt about it. Let's see. We need to also say bridging the trend on this one. So massive trade, 161 on the CAD as well. Some way off, not yet made the first interim. Nice one to hold because it will probably press on a little bit. Got a lot of resources despite the communist in charge. So this is upside setups on yen weakness. Upside setup on yen weakness. I'm not saying don't have the USD JPY. I have it long. And the dollar is going to have to stay out front on the interest rate hikes because its debt is falling furthest in valuation than all other first world nations. First world nations note. It needs to drop. Why? Mega proliferation. So that is it. Let's have a look at the debt markets. By the way, we have tons of these on against the yen. As I've already highlighted, go and get a positive carry. You can even trade the rand yen. Which if you can't trade directly, by the way, you can do a proxy of. You can do US dollar ZAR long, and you can do US dollar JPY short the yen and long the rand, and that will hedge you out. Okay, so time to pivot to different markets. So some people saying it's about the Japanese yen story. Look at this, the USD JPY yield is battling its way up. And what have we said? We've said the debt markets have turned. It's a debt collapse. At any and many opportunities to go sideways, in actual fact, the debt markets will go up. We've already pre-speculated on the US 10-year approximating 5 to 6.5, 5.7%. We're expecting 5.7% on the US 10-year rate. Why? Because we are macro bulls on yield and bears on valuations. And we'd already drawn this falling wedge, and sure enough, today it was cracking on after popping out tomorrow. We in fact even looked at that little fractal previously, and the 10-year next level up top there. That was the high, the 5%. That was a previous target, by the way, 4.9. How do you like those apples? 4.9. Given to you on this channel. We shorted the TLT during this run. W bottom on this call right here. Yes sir, you saw it. It's still up here on the channel. Boom, you get out, you short TLT, you close the trade there, you allow the pullback. Everybody goes, that's it, it's the end. Rates are going to reverse. The pivot, the grand pivot. Everybody's going to want bonds again. No. There are so many bonds come in at such a huge rate on a parabola of debt creation. You will not be able to stuff it. If you're a foie gras factory and you've got an infinite amount of geese there that you are ramrodding down their gullets, you are not going to have the time or enough geese to force down debt treasury instruments. Let's just be clear. Your foie gras factory are going to be liver popping, and there's still more debt coming at you. This is the pink crogs containers in 10, 15,000 oil tanker ships showing up and dumping them in the yard. You can't sell pink crogs. You can't give them away. They're still coming. There's a queue outside from Panama to flipping Houston, all the flipping way loaded to the hilt. You can't quantify the amount and volume of debt and over expenditure with the interest rates at the current level. It is an absolute proliferation of debt. It is so vast. You are going to face an interest rate spike. Again, the milkshake boys don't focus on interest rate spike. That is what's going to throw you out of your property, out of your cars and everything else. We have consistently made this message patently clear. And there's no sell for you here, guys. There's just the self-study. If you want to book a call, hit the first link. It's super low value. Or there's the trading day. I'm trying to save you. I'm trying to save you from something potentially very dangerous. And the real danger is the interest rate spike that America has to stay out in front of. And is it just America's debt that's collapsing? No, I'll be showing you that it's other nations' debts that is collapsing. Only the manipulated Japanese market, where they're killing their currency to try hold up their debt. Why? Major inverted demographics of pensioners that are stuffed to the gills with savings. The little Japanese ladies bought the government debt because they trusted their government. Oh my God, trusting your government. Crikey Moses. Trusting your government has to be the single most obviously corruptible. You are always the patsy. People that trust their government to not be psychopaths and not be undermining you and not make you the patsy at the poker table are absolutely bloody stupid. They are the perennial rapists of you. There is a cartel. They've teamed up, and you are the one that's being bent over and rear end fingered. Please understand that. Please understand that. Government and trust are two mutually exclusive words. They should never appear in the same sentence. But they did, and that's where they are. And they're a big voting bloc, and they always show up. So what does the Japanese government do? Destroys all future generations by destroying the currency, importing inflation by killing their yen. And they stop spending even more. They're even less of a consumer society. They become even more of a saver society. It costs more for their food or anything that's exported. They are energy reliant. Imagine the cost of oil in a fast depreciating yen. Import all that inflation for your quantitative easing policies and currency destruction policies. Look at Japan if you're an American for what's coming your way in due course. Difference being, and there are many differences, everybody does the Japanese parallel. The Japanese bought their own debt. America relies on global markets, international, to buy their own debts. And they've all started watching the Market Sniper channel and realized he said in August 2020, the 40-year bull in debt markets is 100% over. You're going to have a consistent devaluation in the debt markets. Every rally in the debt market should be sold. Every pullback on yields should be bought to go back to the upside. You are two good impulses into your next upside, HVF. And you are now starting impulsively, which is getting the likes of George and Brent waking up to the debt markets again and trying to tell you it's all milkshake. It's debt devaluation. It's debt devaluation. It is a plethora of debt, and it is getting devalued. You can't run trade deficits if the only way you're funding it is on debt and nobody wants it anymore. Your rate has to go up. Your rates have to go up. Nobody wants to buy the pink Crocs anymore. They're not fashionable. There's too many of them. Even the peasants are wearing them. You don't want them. That's what happens. You have to pay me to take them. You need to pay me more yield to take them. For me to go bury them underground, you have to pay me to get trucks to bring them and bury your garbage product underground for you. And you've got to pay me a proper return, and that's called interest rates, and that's why that's going up. And that's why you'll get a small relief, and then, as I expect, you will run 5.7. And is it only an American problem that debt is hyper proliferated? No, because on the same channel right here, go and check it for all the usual people that love to rib us, GBP 20-year. Yes. Oh, what's happening there? What's happening there? We gave you an upside HVF on this one as well and said 7. Listen to the number. 7. You want big numbers? I'll give you a nasty ass interest rate nobody gonna like. 7.6%. How about that? 20-year debt. 7.75. Sorry, 7 3/4, not 7.6. Let me remove that a little higher. 7.75, and it's likely to be run. That means you probably see a possible 8%. You're gonna buy property in the UK? Oh boy, better buy cash and better buy hard and ugly like there's blood in the street, because you are going to be losing capital gains. You're going to lose capital at an epic rate. And if you're trying to get financing when it's happened, you could be looking at the 20-year doing 8%. Good luck with what the retail banking cartel will lend you at, even if they agree to underwrite you, which will probably require a minimum of a 50% deposit. That property market is about to be gutted. This is the British debt market. By the way, again, the ones who called it early drew all the setups on this guy. All the setups on this particular crash. Yes, there's 2020. There's your absolute low. We've seen it coming. We've seen this boy coming. We take it off. You can see the beautiful inverted head and shoulders right there. From the previous low, boom, 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 make it a little higher like that. There she blows, there she blows. The events of CV19, bit of a choppy spell for your right shoulder, double shouldered there, and then up, 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 and away you went. What a beautiful trade it was. Short debt is a permanent hodl trade. Roll long-term puts on the likes of TLT have permanent hodls short yens because they're trying to maintain their debt valuations by controlling how much they allow the interest rates to go. You need a permanent short on American debt that is going to be the front runner on the interest rate spikes that will spike the valuation of dollar, which will imply the absolute crash of their debt instruments and handing on a massive loss to all those holding treasuries, which is the reason why we highlighted Tavi Costa's chart in our Substack, showing that the Chinese are divesting from American debt instruments into gold to ensure that they do not participate in the bath that's coming for Japan, Britain, Belgium, and all the mysterious Cayman Islands. Suddenly buyers that are no doubt proxies for the banking cartel that are maintaining the Ponzi until they're ready to light the fuse for what we've always framed as a controlled demolition. And since we started using that phrase, controlled demolition, intentionally, long time ago, I'm now seeing lots of others talking about a controlled demolition in the financial world. Isn't it interesting? Isn't it interesting how even our catchphrases are getting copied in this great game? It is a debt issue. It is a debt issue. It's not a milkshake issue. It's a debt issue. You are watching collapse in debt, spike in rates, and American debt is the one that needs to be at the forefront of that, although it will not be the only one. And the currencies that are all going to have rate collapses might appreciate, but I expect the dollar will be one of the highest appreciators during that short window. But the main story is bond valuations are going to hit the bonfire. Pensions are going to be bust. All around there will be debt everywhere that no one can repay, which is why holding a physical bar of gold or silver, link below for pure gold, anywhere in the world, for American specifically, ITM trading, link below. Book and have a chat with the guys in both instances and secure yourself something that will still be there, that you can still hold in your hand, that you will still own. This is the great game, guys. This is the great game. This is a major problem for the debt markets. This is why we've shown in our Substack why the dollar relatively stronger. Again, not the omnipotent currency that everyone will have you believe. We have a look at the last 3 years versus the peso. There it is. By the way, that's what's happened. If you put tariffs, last 3 years, 2020 blow off strength of the dollar when everyone panicked into the dollar, down to today. Yes, that's right. 25.8 you had right down to 18.3. This is what happens if you put tariffs on China for imports into America. The Chinese established factories in Mexico, and now you have the same goods coming across your southern border from your friend-shoring neighbor, which you aren't putting the same level of tariffs on. And then you wonder, oh, we're stronger than the Chinese currency. They've pumped the Mexican peso, my friend, at your cost by establishing financial structures, manufacturing relationships that are now seeing your consumer being served via your neighbor. That's what's going on, and that is 3 years. If you want to see longer durations, we've shown this chart countless times and we'll show it again. Monthly on the Swiss franc, the dollar is a busted flush, my friends. The dollar is a busted flush. The Swiss franc is significantly stronger. Here is since 2000, 24 years. And what do you think that will do? What do you think it will do? I don't know. I'm not going long. I'm not going long that. And to all those that said, if the Japanese had only bought dollars, they would have no inflation. If the Americans had only bought Swiss francs since 2000 till the better part of this year, you would have no rises in living costs at all. Well, we can all do that. Have a look at the Singapore dollar, by the way. Have a look at the Singapore dollar as well. It is not just strength in the dollar, which has been fairly firm across most majors, but not universally so. Look at this against the Singapore dollar, my friends. You're in a head and shoulder structure down here after an absolute puke. A puke from 180. That means you needed 1.8 Singaporean dollars to get to buy a single dollar, and today you need barely 1.35. If the Americans had only bought Singapore dollars, they wouldn't have any inflationary effects. And this is the structure you're now in, holding that level, that 131 for now, bouncing off it, coming back down, real hard. Boy, are we leaning on a floor that seems to be a previous resistance now turned support for now, during that once-off bull counter trend period. Boy, oh boy, and we aren't bouncing near as high. Guess what? You would have done better with Singapore dollars. You would have done better with Swiss francs for all of since the new millennium and before. The charts just don't go back far enough. And in the last 3 years, you would have done better holding pesos. That's right, you heard me say that. It's not a milkshake, it's a debt collapse. Rates are going up. Too many containers of pink crogs. Nobody wants them anymore. They no longer are deemed to have a positive value on any great degree. People are not fighting to get them. You are going to be the consumer of last resort. And that is the big key difference to the way this market breaks down. And it's sometimes surprising to me because I don't understand why people want to make this all about the dollar being the strongest right now. It's not the strongest right now as a currency. The whole concept of USD JPY magnifies the perceived strength of the dollar. It is the weakness of the yen. World currency unit, JPY. It's going down. That is a blend of all world currency units from that low. And by the way, if it had existed before, it was all the way down. From literally post-war era the late 40s, all the way to 2011, you're talking 70 years of manufacturing brilliance by the Japanese, you would not have had an inflation effect as a European, a Brit, an American, if you just didn't hold pounds, euros, and dollars. Or before the euro, when it would have been the Spanish peso, the Greek drachma, the Italian lira, the French franc, the British pound. If you just didn't hold any of that crap and you had yen from the late 40s to 2011, my friend, that is 65 going on 70 years. You would not have had inflation. What a beautiful thing to say. We can do this on every currency for every period of duration. What is clearly happening now is the inverted demographics, the lending boom that was encouraged into Japan during the 80s for the total switching into a major debt bubble. Who do you think pushed them into a major debt bubble? Hey, you guys seem to have a savings problem. You're not buying enough of our stuff and you save a whole bunch. We've got a problem with that. It's time you had a property bubble. Let's see. We'll talk to your lenders. Let's drop those underwriting standards. Let's add leverage. Let's take away principles and stoic financial principles. We'll just create a balloon, a bubble to end all bubbles. And they did. And now you're not allowed to let those banks go bust. Maintain the zombie. Must maintain the zombie. The banking cartel is so precious. Oh boy, oh boy. That's it, guys. That's it. That's what I've got for you. By the way, don't forget, trading live with us. There are real trades to be discussed right here, right now, building up during this week. This Friday, live trading with us on the non-farm payrolls. You will be able to click the link below. Join us for a non-farm payroll live trading day where the data comes in and we can potentially take trades and discuss all the markets, including crypto. Yes, indeed. Interesting period developing there. Also, if you want to book a call for the self-study, get your theory done, participate on Sundays at a lower, less intense level, slowly assimilate all the information, and then have that as your good faith deposit for when we make TMPs available again. Currently not available. Book a call to talk to us about the self-study and the amazing new Kajabi feature where it is you can leave your comments, watch the video, all the codes, the tests at the end. What do you get apart from features? What do you get? What are the benefits of this? You get to take your time assimilating what it is we do. You see case studies of how we've done it, wrong and right. You get to see and practice. Then you have a Sunday live session where we analyze the specific markets and talk about actual trades that you've seen the theory of. So not only do you see and watch the theory of history and how it's done with images, diagrams, beautifully recorded in terms of audio with real PowerPoint slides, case study, all the way through. You get to then interact and ask your questions on Sunday about the live market. Then you will attend events such as the live trading day where you'll have the access to myself and we will carve up both markets for an hour and a half for the better part of 3 hours, both the traditional markets first and then the crypto markets, where we think maybe there could be a little bit of a pivot, or will we have to crash first? Who knows? Rates going up on the debt markets across the board. I will leave you with TLT, which I promised to show you and I didn't. In fact, so that's a remit. This is the chart that you should consistently be short of. TLT. And it's had a strong rally period. We called this head and shoulder. We called this earlier break here to the short side, right up at 162. That was August of 2020. And we expected it to bounce and right shoulder. It was a bigger right shoulder than we thought. We expected that to trigger. It delivered our target. A very good fall. Then it rolled over. Let's show you that on a smaller time frame. You got caught in a channel there. We expected that falling wedge to break you through. Another spill. Then you got the pivot factory, guys. The pivot. You're in a broadening structure. Look at this gap and fall down. Broadening structure on a downside. As much as we are seeing on the US 20-year, 30-year and the 10-year higher rates. So you will see loss of value in the long-term iShares 20 plus year Treasury bond ETF. This is a short. You will trade through this low. You will continue to go lower. That head and shoulder was a seminal 40-year trend changing event. Nobody talks about this as they should. Debt trend changed in 2020. And there is no slow 40-year escalator up. This bugger is going down a lot quicker. It is a position trade for 4 years non-stop. Literally like the short on yen, short on TLT. Short on yen, short on TLT. These are your key trades. Short American debt, not Japanese debt, which is being fake held up. Short the currency, the second valve that is failing for the overall pressure in the Giza tank is the currency on the Japanese. It's the debt for the American. Short TLT. That is it. Prepare your personal finances for an interest rate spike that could get disorderly. These are our core messages. That is why we are more practical than milk coupon guys. They give you the real trades, the real aspects that can build you wealth in what is a reset event. You are going lower on debt valuation. That means rates up. Plus, the Fed is going to be buying, and it's going to get potentially disorderly. And while it's getting disorderly, they might need a war or something to distract you to create some demand for the military industrial complex, the pharmaceutical industrial complex, potentially the banking complex, a hack, a this, a CBDC, who knows, they will all possibly happen, but they will seek to create events that will distract you from the fact that this is a debt collapse. Repeat after me. Francis told me this is a debt collapse. This is the cornerstone of what's going on. Debt collapse equals rate rises. Rate rises, not good for people who've borrowed, especially if they can't pay it back. Okay, till next time, we'll catch you for the live trading day on Friday. Don't forget to book the Rick Rule tickets if you feel like seeing us at Boca Raton as well. And on top of that, that self-study program where you get 6 months opportunity to absorb the theory, get to interact with us once a week and with me once a month in the live trading days, and have opportunity after 3 months still to upgrade when we make the Trading Metamorphosis program available again. Until next time, I'll catch you later. Bye-bye.